Hey folks, welcome back to Honey Money SG, and I finally decided to try out options trading as a newbie for 2 months. Now I'm sure you have seen some options trading video talking about how it can help you achieve passive income every month, thousands of passive income, and then it will help you accelerate to financial freedom. Just to put some things in context, this is not my first option trading experience. I actually did try a little options trading in the last year, 2021, when everything was a bull market, right? I did make some money initially as a newbie, but I think greed took over me and I started putting in more risk than what I can expect. So in the end, it was a total net loss. I think a few hundred lah, not a few thousands. So luckily, it was a small loss for me. And then I took a break, okay? Because I'm really quite scared of losing so much money within a short period of time. But I decided to come back again since June. So this will be my brand new start. My first options trading experience since 2022, start of June till the end of July. So maybe through this beginner sharing options trading experience, you all can see what to look out for, what are some mistakes that you should avoid, what are some good notes that you can take down. But of course, I'm not an options trainer. Definitely what I say here is really for entertainment purpose and not financial advice. If you really want to learn good options trading material, maybe you can look at other content creators like Adam Khoo, or even my friend Kelvin. He also talk a bit of options, but I'm definitely not as good as them. They have been doing it for years. I'm just starting out for 2 months only. So you cannot compare my experience with them, okay? I'm really just a beginner, a noob, so take that in mind. So my option strategy is really to sell a bull put spread. For some of you who don't really understand options, there are two sides, right? One is the call option, one is a put option. Specifically, I will talk about the put option. A put option is essentially a contract of sale, which is opposite of contract of purchase. A put option will dictate what is the strike price that you are willing to sell at. So as a seller, you are giving your promise to the buyer of the put option that I will let you sell to me this particular 100 units of stock at this strike price by this date. So you're giving a guarantee to the buyer of the put option, which is why the buyer has to pay you money, right? You are the seller, you gain money from the buyer. So for example, Apple stock is around $150 now, right? If you sell a put option at strike price $100, maybe 1 month to expiry, you are giving the put option buyer a guarantee that if the Apple share price actually dropped to below $100, I will still let you sell to me at $100. Thereby, you as a seller, you give to the buyer the guarantee that he is able to sell you 100 units of Apple at strike price $100. Even if Apple really crashed to $50 by the next month, right? He is still able to sell you 100 units of Apple at $100 strike price. So this is actually a bullish strategy because you believe that Apple not so cui one. Apple is not so weak to fall below $100. You believe that Apple is bullish in the short run. That's why you're betting that the 100 strike price will never be reached and the option will expire worthless. Thereby you collect your premium, your buyer won't exercise the option because the price of Apple is probably above $100 by the date of expiry. So that's the selling put part. But I have another side. I need to cover the downside, right? Because the loss is actually unlimited for just selling puts. You have to cover your base, cover the downside. And that's what I did. I buy a put at a lower strike price. So using the earlier Apple example, let's say I already sold a $100 strike price put option on Apple. I will buy back a $80 strike price put, meaning that the seller of the $80 put option of Apple is giving me a guarantee to sell Apple at $80. If Apple stock price actually breached below $80, I will be able to sell it at $80 regardless of how much it crashed. So it kind of covered the downside for me, right? On one hand, I sold a $100 strike put. On the other hand, I bought a $80 strike put. Of course, when you buy put, you have to pay money, right? So that kind of reduces your premium or your net profit if both options actually expire worthless. But at least you have covered your downside and it's not like unlimited downside, it's a limited downside. So I know this may not be the best and clear explanation, but bear with me here. I'm just a beginner and newbie in this. I'll try to be better and improve next time. Okay, so now the strategy is, instead of Apple, I'm going to sell put and buy put on Tesla stock options with a 30 days date to expiry because I believe the Theta decay will be the largest when it's a 30 days time frame. And I will not do it every day, I will only start selling put when Tesla have a massive drop like 4 to 5% a day. So if one day like Tesla really chong up like the past week, right, I won't really touch on any put options yet because you must understand that Tesla stock performance is actually very volatile. And if I have a smaller upside compared to a larger downside, then I may not want to start a position because I'm conservative, So regarding the strike price, right, I try to choose between the $600 price range, both for the sell put and the buy put. And then I see what's the premium. Usually around $20, I will sell the put at a $20 premium. And then I buy a $10 premium put. So if you net off these two orders after a 30 days date to expiry, the net gain will be 1000 USD because 20 minus 10, that's $10 multiplied by 100 units, that is 1000 USD. And that's my target profit, right? Because I only aspire to earn around 1000 USD per month on options trading. I don't really need more because 1000 USD is definitely sufficient for the lifestyle, and also I don't want to take too much risk. 1000 just nice for me. And also it doesn't mean that I have to wait till the options expiry date to collect everything on the premium side. I can actually take profit when the 50% target has reached, which means the net profit is around 500 USD. Then I'll start to close the positions on both the buy put and the sell put side. That is also because one bird in hand is worth two in the bush, right? If there is a one day the Tesla stock suddenly rise super high and then my sold put really decayed really fast on that day, then I will take profit on it and cover my buy put as well. Meaning I close all my options positions and then take a 500 USD profit, which is really good enough for me because I'm not greedy. If I can take a 500 USD profit by the half of the month, then the next half I will start a new position and try to capture the same profit again. Hey, have you heard about it? Huh? Heard what? I got $100 worth of Apple shares for free. Are you sure or not? How did you even get it? Well, I started using the Weibo app and deposited $2,000 and make 6 buy-in trades. If you don't believe me, you can take a look at my Weibo app right here, showing you $100 worth of Apple shares. Wow, is that really such a good thing for free? Can you teach me how to do it? So you can start by using my Weibo referral link down below, sign up and deposit the first deposit of $2,000 in Singapore dollars and make 6 buy-in trades so that you can qualify for $120 worth of Microsoft shares. Weibo also gives you 0 commission fees and platform fees for all stocks, ETFs and options in the US market. So make sure you sign up for a Weibo account using my link before the expiry date. And with that, let's get back to the video. So these were the following trades for my past 2 months. During June, I started with a date to expiry of 8 July, bull put spread. I bought a $530 put at 980 and then I sold a $590 put at 1950. I've closed both positions after the theta decay for a few days and Tesla stock went up a bit, and then the net profit was $4.30. Multiply that by 100 units and deduct away the commission cost, I got a net profit of 428 USD. So that was my first realized gain of the Tesla options bull put spread strategy, and I continued with it. So following my trade number 2, using the same bull put spread strategy, I achieved a net profit of 318 USD. You can refer to the strike price, the opening price and the closing price and the realized net gain over here. And even for my trade number 3, that was a net profit of 618 USD, and followed by trade number 4 where it was the highest net profit at 624 USD. That was really because of the strong run up in Tesla after they announced the results last week. Do you remember that? The strong rally in Tesla stock. So as of the date of recording, I have closed all my open Tesla option positions. I could have earned more if I didn't close it, but I felt that it was enough. And if you calculate the total profit of these 4 trades within these 2 months, it's close to 2000 USD, which is close to my target profit already. And the reason why I did not just let the options take its time to decay is because I believe in the Chinese saying called 见好就收. When the circumstances are good enough, you just close it and take it. Because like I said, one bird in hand is worth 2 in the bush. And if the tide turns, right, there's also a Chinese saying, you know, 见不好快收. If things have gotten really bad, then just take the loss and cut losses, because this is a trading position. This is not a long-term investing position. It involves a little bit of speculation and timing the market, which may not be in your favor. So my final learning points is that options trading is not for everyone. While it has been working for me, it may not really work for you because of your risk profile. If I manage to get 7 out of 10 trades right, that will be really good enough for me. I don't aspire to be like 100% hit rate in all my options strategy. Ultimately, options trading is about timing the market and involves a little bit of speculation because you are timing the market in the short term. So it's really not like long-term investing when there's fundamental analysis involved. Maybe it requires a little bit of technical analyst skills, and therefore that's not really recommended by beginners, because if you have the gambling mindset, it will really burn your fingers like what I did last year. One more important thing is that I only started dabbling in options trading after I have secured my CPF SA retirement funds and basic healthcare sums in serious mode, okay? Because those are really your financial safety net. And before you even take on all this high risk thing, you should really go and secure the low hanging fruits like your CPF, topping up voluntary contributions to it. Then you have financial safety net, then you can start to dabble on all this higher risk stuff. So if you want to understand my thoughts on why I top up my CPF and what were my reflections 6 months after reflecting on reaching the full retirement sum, then take a look at my earlier CPF video right here. With that, thank you for watching. My name is Christopher. This is Honey Money SG, steering young adults to financial independence.